Three stocks I'm buying, August 2022 edition. Super excited for this, but first, if you're new here, I'm Austin. I'm a co-owner of cloudmusicsuite.com. On this channel, we talk all things money and personal development. If that sounds up your alley, go ahead and subscribe. All right, three stocks I'm buying. Before we get into the individual three stocks that I'm buying in August 2022, just want to provide some context. Number one, I am not a trader. I am rather a long-term investor. So my shortest time horizon ever is 1 year. My longest time horizon could be my lifetime. I have only a few stocks that I plan on holding for my lifetime, but I do have a few. So somewhere between 1 to 5 to 7 years is my time horizon for a stock. So if that means there's some pain in the short term for a stock, I really don't care that much. I see that as an opportunity to increase my ownership position. So we're not talking about trading these stocks, getting in and out in a short period of time. We're talking about investing over a long period of time, at least a year, if not 2, 3, 4, 5, 6, 7, 8 years. So let's get into it. Number one stock here is Palantir. This morning, this is the 8th of August, 2022, Palantir reported earnings, and it was, I don't want to say a disaster, but the market viewed it as a disaster. And looking at my little screen here, we're down like 11% right now as of recording this video. So Palantir is a 20 billion market cap or so, might be a little lower after today. And they're slated to do about 2 billion of revenue this year, and that's up probably somewhere around 20% from last year. They had to reduce their guidance recently. Does that mean the growth story's dead? No, absolutely not. Growth story's still alive, but these bigger contracts that they have just take time to get, all right? And we're in a recession. US is in a recession factually. There's been 2 quarters of GDP negative growth. That means we're in a recession by the definition. And as we go into recession, more government spending gets pulled back and more commercial spending gets pulled back. That's just how it goes. So these longer term $1 billion+ contracts that Palantir is trying to sign just don't get as much love. If you don't know anything about Palantir, let me give you a short, succinct version. They own 3 platforms, okay? And these 3 platforms are Foundry, Gotham, and then they have one called Apollo. Foundry typically is the one that they try to use for commercial purposes, so they want to sell it to a business. So this is a business to business work here. Gotham is normally what they try to sell to government agencies like the US government. And then Apollo is anything at the edge. So they want this to be, it's called Apollo. So they want to be able to use this in space. They want to be able to use this at deep sea. They want to be able to use this anywhere where it's not an optimal condition. That's who they're trying to target with the Apollo product. Anyway, so those are the 3 products, and there's pretty much a big data play. So they take all the data that a company or government has, and they try to aggregate it, meaning summarize it into a shorter list so that they can make sense of this data. And they have AI that tries to help with decision making. So I seen a case study on Airbus, and Airbus uses Palantir. They're a Palantir customer, and they want to make creating planes a little bit more efficient. And apparently they were able to do this by like 20+% using Palantir's product, which is very impressive. Anyway, let's talk about valuation metrics and what I think is going to happen with Palantir over time. So Palantir, like I said earlier, is about a 20 billion market cap. They are not profitable yet, which if you're not about unprofitable companies, then full respect. And this isn't the stock for you, but I do believe they're on the road to profitability. So they're about to turn that profitability corner, and I think they're going to get a lot of respect because the value investor can see the price to earnings ratio, which is a ratio that a lot of people use. They are free cash flow positive right now, but they are unprofitable due to high expenses and stock-based compensation. That stock-based compensation is going down over time. They're at a price to sales of 13. So that means they have a little bit less. That's a trailing 12-month, a little bit less than 2 billion in revenue, but I do think they're going to do 2 billion in revenue this year. So that forward price to sales, my projection would be somewhere around a 9 or 10, which is pretty close to in line with Microsoft. And Microsoft definitely doesn't have the growth that Palantir has. So just some thoughts there. they have a 52-week low of $6.44, 52-week high of $29.29, extremely volatile. This is a relatively risky stock. I'm not going all in on Palantir. Probably about 10% of my portfolio is in Palantir, which I know is a lot, but I feel comfortable with the company, and I'm going to be adding more as this short-term pain persists. We're now at 12% down as I'm recording this video. So, number one, Palantir. Number two stock that I'm buying in the month of August is The Honest Company. So The Honest Company is a diapers and wipes company. Normally, their core business is diapers and wipes, and they also sell beauty products. So makeup, facial serums, eye creams, stuff like that. And they also have soap products. On an earnings call about 3 months ago, they said they were going to get into the supplement situation industry. I'm not super excited about that. I'd rather them just stick to their core business of diapers and wipes, that's some solid stuff. Recession proof, we'll just say. Beauty products, and Jessica Alba is the founder of this company. So, not only say free pub, but anything Jessica Alba puts on the internet, people are gonna eat it up. And she's using her own Honest products, of course. So they have great backing in terms of like marketing presence, and the fact that she's the founder, they don't have to pay her, for these marketing efforts. So they get to save a lot of money in terms of advertising just because Jessica Alba's name is on this, and her web of people that she knows who can use the Honest products, and shout out the Honest products. It's amazing. So it's a great situation. I love the Honest Company. We're sitting at 367 million on the market cap. The last month, July, I was also buying Honest Company, and it was a lot lower price back then. So we've had a Walmart announcement, which had already been announced before, but they officially announced the Walmart rollout, and that got 16% or something in a day, and then got more and more hype over the next few days. And today, which is August 8th, there's no real company news, but we're up 12% on the day. So I've been super excited about Honest. I'm still going to keep increasing my ownership position. I'm not at my goal amount of shares yet, so I'm going to keep going. Even though the stock's moving up, I'll just buy lighter as it trends up, and I'll buy heavier as it trends down. I'm not mad about paying $4 a share for Honest. Sitting at a 1 price to sales. A 1 price to sales. That is a thing of beauty, okay? So from a valuation metric in terms of revenue, I'm very excited. Balance sheet is in a great position, and they are not profitable yet either. So they're in the process of becoming profitable. They're about to turn that profitability corner. And as we know, anytime a stock is about to turn that profitability corner, they get a lot of respect. Market comes flooding into the stock once they turn a profit. And they can take these losses that they're accumulating right now, and they can pull them forward to write off against future profits. So it's not the worst thing in the world to invest in an unprofitable company, as long as there is a clear path to profitability and you can see that path and you can follow that path. If that story changes, maybe that's not a stock for you for the long term. But if the story is getting better and better and better, and they're getting closer and closer to profitability, that's a stock to look into. All right. Number 3 company that I'm buying is SoFi. So SoFi Technologies, this is a fintech company. They have a whole host of products, and they're just expanding these product offerings about every month. You can get your student loan refinanced through them. You can get a home loan through them. You can bank with them. They have the best interest rates around, honestly, on this savings and checking account. You can invest with them. You can buy cryptocurrency if that's something you like to do with them. You can get life insurance through them. And they also own this platform called Galileo. So Galileo is the back end of other finance companies like Chime and Dave.com, if you've heard of those. So they run their whole back end on Galileo. And then Galileo can collect, depending on the contract, how it's set up, they either collect regular revenue, just like contract value, or they collect a percentage of all revenue that comes through, like on a credit card or something along those lines. Galileo is an absolutely amazing platform. SoFi acquired them, and SoFi just recently became a national bank. Their first quarter that they reported as a national bank was ungodly ridiculous. So they reported about a week ago, amazing earnings report. Stock went up like 25%. I still am going to be buying shares. I wish it was a little lower than it is now, but I'm still not mad about picking up SoFi at $8 a share. Price to sales on SoFi is around a 6 with a market cap of 6 billion-ish, maybe 7 billion or so after today because it's got a little bit of a rise. So 7 billion, we got a price to sales of 6, doing about 1 billion in revenue. And I think that number is going to continually increase. The year-over-year revenue increase has been completely ridiculous, and we're expected to get about a 40% increase in revenue again next year. I think the path to profitability is about to play out. So this is the third one where I'm talking about path to profitability. These 3 stocks have been shredded over the past 6 to 9 months. It has been terrible sledding for these stocks. Any money-losing company has been completely disrespected and forgotten about, including SoFi, including Honest Company, and including Palantir. So I see SoFi getting to profitability in the back half of 23, maybe mid-2023. So I'm super excited. I love SoFi. Yeah, doing great things. Could break 2 billion in revenue next year. So that's the generally accepted estimate. It's about 2 billion next year. Man, I'm excited for this growth story to play out. So SoFi is number 3. One stock that I have not been buying, but I really want to add more of. I started a little position. It's gone up at least 30+% since I've bought my initial shares. First Watch Restaurant Group. So First Watch, if you never heard of them, they just have morning and like brunch time. So I think they close all their stores at about 2 p.m. You can get breakfast all the way up until 2 p.m. and they have no plans of opening past 2 p.m. What I like about that is they have a niche, okay? They are just the breakfast place and the brunch place. Super cool to me. Every single experience I've ever had at First Watch is amazing. The wait staff is great, the food is great, the environment is great, the price points are respectable. I love everything about First Watch, and I love the valuation at a market cap of 1 billion, almost exactly 1 billion. We got a little bit of a rise today, so that number might be off slightly. And when we're looking at valuation metrics, we're at a 1.51 price to sales. So if we compare that to Chipotle, another restaurant, at about a 5.5 price to sales. So that's completely ridiculous. First Watch is growing faster than Chipotle. No, they're not as profitable yet, but in terms of revenue growth and new stores and quarter-over-quarter growth, First Watch, the growth story is much stronger in my opinion than Chipotle. Yes, Chipotle has a slightly better brand, but First Watch is doing a great job of building their niche, all right? So, and First Watch, there's so much expansion possibility, even just throughout the US still, and I'd say Chipotle, there's not a crazy amount of expansion possibility with Chipotle anymore. So when we're looking at valuation metrics, I love First Watch at a 1.5 price to sales. Even though it's a little bit higher than I would like to buy it at, I should probably get less picky around the pricing and just add more shares. So comparing it to someone like Chipotle, I wouldn't consider them a direct competitor, but similar type company, similar type price points, all right? Similar type people who go to Chipotle, same type of people who go to First Watch. Generally looking for healthier options, normally like middle class and up. Same thing at First Watch, generally looking for healthier options, middle class and up. That's what we're looking at there. So love First Watch. If you're looking for another stock, there's a bonus one, number 4. Check it out. All right, that's all I got for today. Let me know what stocks you're buying in the description below, or excuse me, in the comments below. And that's all I got. So have an amazing day.